Hello, and welcome to Pro Trader Strategies Market Commentary for Wednesday, April the 5th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that I talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. As I mentioned yesterday, we do have a lot of economic data coming out today, or has come out today, I should say. We had Spanish services PMI come in at 57.4, right in line with expectations. Italian services PMI pulled back a little bit at 52.9, expected to be 54.3. And then the services PMI for the French came in at 57.5, expected to be 58.5. And then the German final services PMI came in at 55.6, right lockstep in line with what was expected. Great Britain services PMI came in a little higher than expected at 55.0. And then here in the United States, we had ADP non-farm payroll came in at 263 hires, expected to be 184,000 hires. That's what really caused the overall the overall equity rally, because our services PMI really came in line with expectations at 52.8, was expected to be 53.1. Now that services PMI isn't the ISM, but the ISM number, which is the more widely looked at or more regarded number, non-manufacturing PMI for the ISM in the United States came in at 55.2, expected to be 57.0. So lower than expected there. Should have maybe caused the equities to come off a bit, but I think that ADP non-farm payroll was really the catalyst to get the equities moving higher and getting NASDAQ to create all-time historical highs. Then we had the crude oil inventories coming in at 1.6 million barrel build, was expected to be a drawdown of 100,000 barrels. So another big increase in crude oil, and it is, as you can see, causing crude oil to wane a little bit. Now, crude oil was rallying off of the ADP number as well, created those highs, came up and tested that value area high, as we can see here on the chart, came up, tested that value area high, but when its economic data point came out in the form of crude oil inventories, we saw a little bit of a wet blanket thrown on crude oil. It's still looking pretty good for maybe a bit of a pullback, as I am bearish in crude oil just because we consistently see these builds in crude oil inventories, giving me the idea that they're not shutting off the spigot and there's just not a whole lot of demand out there. These guys are really churning this oil and turning it into gasoline, distillates, and other things for manufacturing. Just not seeing a whole lot of demand right now. You would think we'd be seeing it out of the manufacturing side, but I don't know that we're really seeing that yet. Then we have gold futures right now coming back off, down below earlier this morning and kind of right below that 9-day moving average that's been acting as support. It's kind of acting as a bit of a support right now, albeit we are slightly below that. But with the crude oil inventories, not the crude oil inventories, with the non-ADP, non-farm payroll number coming out better than expected, it's kind of a flight to quality. People are pulling out of gold and throwing it into the equities as we speak. So gold futures doing what we would expect and coming off as we're seeing a nice rally in the equities. Then we've got bonds, right there at the point of control where the most volume has been traded. Today we saw a move down. Now we're seeing the time elapse down here as well. Remember yesterday it was up here. I've been talking about how this is a really kind of a wanky market profile. It's kind of come into line a little bit better, where the value area for the time has moved down lockstep with the volume. So both of those right there making it a little bit more comfortable to trade at these levels for most people. Then on to the equities. So we can see the Dow Jones Industrial Average up over 160 points right now. Really blasted off on that number. We'll see that in the breakdown of the E-mini S&Ps. But as you can see here, the Dow Jones jumped above that 9-day moving average, which was acting as resistance for the last several days, and blasting off to the upside. This is what I was talking about with the NASDAQ. NASDAQ up 31 points on the day, creating an historical new high, and we are very close to that. People pulling out of gold and other ancillaries, throwing it into the tech sector, which is generally a little bit more volatile. So NASDAQ pushing higher, up 31 points. E-mini S&Ps, again, same situation, up 15 points on the day, 15 points on the day, just slightly off the highs of the day, but consistently moving higher. We're not seeing those lower lows and lower highs anymore. So we were seeing that a little bit there. Thought we might get a breakdown below this to get the lower low and come down to where I thought we were going to go down and test this 2260. That's kind of been thrown out the window at this point. It still could be, some technical traders could say that if we just don't break above this high right here, that lower lows, lower highs is still in effect, because it really hasn't broken that upside there. So as of right now, it's a little bit touch and go as of whether or not we're going to be able to get down there to that 2260 area I've been talking about. This is the E-mini S&P on the 15-minute chart, 30-minute chart, last 20 days. As you can see here, this is on the economic data points. We really blasted higher. We did get a bit of a pullback on the crude oil inventories number. That's where we started seeing a little bit of weakness, because if there's not really demand out there for crude oil and crude oil comes down, it really has a tendency to pull the equities with it. So just keep that in mind going forward. They should be pretty much correlated at the end of the day. If there's no demand for gasoline, it means that the economy really isn't doing as well as some people may believe. So keep that relationship in mind. With Target, it's been down here battling at this bottoms. I just really think that Target, Walmart, those two companies, since they are in the produce and food, kind of the grocer, if you will, and not just the retail aspect, I think that they're going to do actually pretty well. We're seeing here in Arizona, we're seeing actually a lot of grocers start to close down. We've seen a lot of Fry's close down. Albertsons is looking to close a lot of stores. So those different grocers are not doing well. Kroger, on the other hand, they have a great model. They actually, I could go into a long talk about Kroger, but I think that they're going to do pretty well, because they monitor the ebb and flow of their consumers. So, but anyway, with Target, I think that they've kind of found a bottom here. I'm looking to take advantage of high implied volatility in here. It's not super high implied volatility, but it does meet with my rules on high implied volatility. So I decided to add a short put spread in there, giving me some long deltas in the retail sector here. So I went into, I'm pretty hedged in the retail sector. If you've been keeping along with the Macy's, I'm kind of short some puts in there, but long deltas in Macy's, but short deltas in the ETF for the retail sector. So decided to add a little bit of long deltas here, just because as a contrarian, when it's at extremes, that's when I want to add some long deltas. So I did that here in Target, ticker symbol TGT, and went into the April because I didn't want to be playing around in that month with the earnings. As you can see, next month we have earnings, so I just went short duration and did the April, sold the 53 puts, and then bought the 52 puts to define that risk, collected 27 cents for that trade. So don't have a whole lot of time. I'm going to be able to take away some theta on that. Hopefully I can get out of this rather quickly. If we just get a bit of a pop there, I think that I'll be able to cover this rather quickly. So that's all I got for you guys today. Stay tuned because we got all kinds of earnings coming up real soon, and we are going to do an earnings segment where we're going to be doing a 4-part series on my favorite earnings trades to take advantage of volatility crush, increase our probabilities of success, and you got to check that out. Sign up for them. It should be a really good one. All right. That's about all I got for you guys today. Go to protraderstrategies.com and get on that earnings, because that's where I have the most fun and have a tendency to have my best successes. All right. So that's all I got for you today. If you can't take that, take it easy.